All right. Hi, everybody. Welcome to the show tonight. Give me a little thumbs up in the chat if you can hear me, if you can see me. Hopefully, everything is good to go. Really excited to put on the show for you tonight. I've got a few fun things that I want to talk about. So I want to start with something I'm going to call the market outlook. I often do this right at the start of the show just to be able to kind of kick things off. Oh, I'm getting some congratulations for the things. Yeah, so why don't I start with the good news? That's a good place to start. Two cool things that are happening. The first is that I got my CFP designation. So you can see here, it's kind of cool. It was a little anticlimactic. I had to come and search for myself in this database to find out that I had been approved. I passed all the exams back in November, in December, but I didn't actually get the designation. Oops. Let me see if I can search for it here. Here we go. Search my name. And so I am now in their system, I believe. Oh, it's not. Hold on. One certificate's found. Where am I here? It didn't show me. I'm like, wait a minute. This is supposed to be the Find a Planner tool. Tim Nash, clear. Let me go back here. Hold on. Let me start over. So I've got my Certified Financial Planner designation now. You should be able to find me in this database. If I search for Tim Nash here, let me see. Search by name. It says one certificate's found. It's not showing me, so I'm going to assume that their website is just not loving me right now. Oh, here I am. It was hidden. There we go. I just had to go full screen for a moment here. So you can see I'm now in the database. So that was a huge win for me. This was 2.5 years for me to be able to get this designation. Had to pass all kinds of exams and tests. So really thrilled about that as well. It was super cool this year. I did win an award from the RIA, the Responsible Investment Association, where I won an award for individual leadership. And it was really because of all the media that I've done over the last year. So in 2019, kind of went through and just counted up all the different appearances that I've done. BNN Bloomberg 7 times, including 5 appearances on Market Call, which is that live call-in show. 2 features for CBC's The National. CTV's Your Morning. I went on a morning show, which was I'm not usually up that early, but I did pretty well there. 3 times each in the Globe and Mail and the Toronto Star, twice in the National Post, once in Chatelaine. 5 podcasts, 3 radio programs, and a Reddit Ask Me Anything. It was an incredible year. So to me, it was just so cool. I've been involved with the RIA for a very long time, since it was the social investment organization. So many people I know and respect have kind of been honored by them. So it's a big deal for me to have been honored there. Big wins for me this week. I'm feeling really good. Energy levels are high. We're definitely some interesting things happening in the market. So let's jump into the market outlook just so that you can see, today was a rough day in the markets. S&P 500 down almost 6%. Toronto Stock Exchange down about 4%. Not hugely surprised here. I've been kind of waiting for this. Leading up to this, the last 2 weeks have been just a little bit ridiculous in the stock market. If we look at this all country world index over the last 6 months, right, we can see before the crash and then the crash. And then if you remember when I was on a couple weeks ago, I was talking about a slow sort of escalator, like a treadmill going upwards, right? And then all of a sudden it just popped. And really from May 22nd, up until June 8th, it just popped. So really what we've seen is in the last couple days, it's sort of fallen back down a little bit, including down over 5% today. But I'm actually kind of happy to see that. I really felt like in this run-up that there was something just sort of unsustainable about it, that it just couldn't continue. My best guess is that there are 2 reasons why it went up. The first big one is so much support from the Federal Reserve, from federal governments, the U.S. government, the Canadian government, the Federal Reserve in the U.S., the Bank of Canada here in Canada, with so much support. I think investors just sort of basically said there was no risk, that if there is another market crash, if things get hurt, then it's not a big deal, because really the government and the Fed is going to step in to protect us. So it's almost as if people were investing with kind of reckless abandon. And we saw some also really funny movements in specific stocks. So the other thing that's happened, and this is a bit of a theory, so I don't have data to back this up, but I've started to see a really funny trend where people who normally bet on sports, because there are no sports right now due to COVID, have actually started betting in the stock market, have kind of turned from sports betting to now betting on stocks. And we're riding things up. We saw some really funny behavior. Hertz Rent-A-Car is something that stuck out. This is a company that filed for bankruptcy. So if we look at it, this was in February. We knew it was going to be hit pretty hard. We can see a Hertz bankruptcy just to see when the announcement was. And that, I think it was a little while ago. And then this question, this kind of speaks that Hertz is bankrupt. Why is everyone buying its stock? That for whatever reason, we saw it like spike up to go from like 85 cents up to like $5, right? And then again, back down. Now it's kind of coming back down to a value where it should be. We saw the same thing. Tesla is something that a lot of day traders love to trade. And so when we look at this, I'll just show you over the last month, and you can just see it's just been up and then up and then up. Now it's coming back down a little bit, but really when we look at Tesla shares, like I remember back in February, we thought it was overpriced. Like how could it be worth that much, right? And then now we're right back up there. And this is something that a lot of the day traders do really love. So I'm just kind of seeing this funny trend. If anyone is on Reddit, there's this thing called Reddit Wall Street Bets, SWSB. This is like Wall Street Bets, which is a subreddit where, I've just seen a lot of basically like day traders. And it's a very, very strange thing, but someone will put a company that they think is going to do well in this thread, and then more and more people are just going to buy it, and we're just going to see it shoot up. It's very common with smaller companies. There was this one called Genius Brands, which does like kids programming, and it's like a penny stock. Like it was 25 cents, all this, and then all of a sudden here, 58 cents, and then look at this. It just spiked up to almost $8. Like this makes no sense, and this was because people were posting about it on Reddit. So there's a really funny psychology when it comes to sports gambling. If I bet money on, let's say, the Toronto Maple Leafs, I want the Toronto Maple Leafs to win, then if a lot of people bet on the Toronto Maple Leafs, that doesn't actually increase their odds of winning, right? The game is still going to be whatever the game is. But when it comes to stocks, especially penny stocks, if enough people think that this Genius Brands International is going to win, people can absolutely drive up the price of the shares. It gets to a level where really, and oh my goodness, the people who bought in at these high prices, I feel so bad for them because they just watched their money evaporate. So, this is my way of saying be very, very cautious, especially with individual companies. There's a lot of these like hot tips and a lot of this sort of like, almost like gambling going on. And so really my impression is that, those two things, this sort of, I would say, hubris that the government is just going to step in and the Federal Reserve is just going to bail us out no matter what, has really led to this run-up. And that in the last couple days, and especially today, with things being down so heavily, is really just sort of the market, coming back to earth a little bit, being a little bit more rational. My guess is that it's still trading at slightly above where I think it should be. I feel like in sort of this range where it was about a month ago, that's probably an appropriate level. So we'll see. Obviously, there's so much we don't know about a second wave. There's so much we don't know about, the U.S. Election that's happening in November, that in my mind, for it to be back to close to where it was like at the start of the year, with all the risk that's in the market, just, we thought it was overpriced back in January and February. For it to be up near those prices today with all the risk that we have is a little bit ridiculous. So, not surprised to see it come back to earth and to see a little fall. I think there might be a little more fall, but hey, who knows? I think it's still, another couple months before the NBA and the NHL are going to do their playoffs. I want sports to come back, not so much for my entertainment, but so that all the gamblers can just go back to sports betting and can get out of the stock market. So, always fun to be able to look at things like the VIX. So I do like looking at this volatility index. You can see it was nice and calm for quite a while, and then it's just spiked back up in the last couple days. Again, I think there's just a bit of a funny little, thing happening in the market right now. So you can see that's reflected in the VIX. Always also nice, I do tend to look at the price of oil. I like showing you that. Just to be able to see what oil prices are, that has such a huge impact on the Canadian economy. You can see this is West Texas Intermediate, which is the sort of light sweet crude. You can see it's really come back up, about 36 bucks a barrel right now. And then if we look at the in Alberta at about 27 bucks a barrel. So really, what we saw here when things were really in the depths, we are starting to see prices come back up. That it really does look like that was sort of a short-lived phenomenon of oil prices being so low that now things are a little bit back. So that's where I think where we're at. Of course, people are always going to ask, is now a good time to invest? I would say, well, with markets down as much as they were today, certainly, tomorrow is going to be a better day to invest than yesterday was. But I do think we might see a little further pullback. Don't have the crystal ball, but I would say that things are still very, very optimistic in the market. And I think all it'll take is a little bit of bad news to be able to send it tumbling down a little bit further. And, there is some progress on vaccines and on the health sides, and we are starting to reopen the economy. So, hopefully those things go in a manner that is safe, where people are able to get back to work and to live their life. But also at the same time, I think that things are fundamentally changing and have changed in ways that we don't totally understand yet. And I don't know if the market fully appreciates that. There's one ETF, JETS, which is airlines. And again, you can see, obviously has been hit really hard. Of course, it's airlines. And you can just see that, at the end of May, it just kind of jumped back up. I think there was this optimism that like, yay, the economy's opening, things are back to normal. Of course, airplanes will be fine, airlines will be fine. We're going back to normal. And then now, just in the last few days, it's like, actually, COVID is still a thing. There could be a second wave. There is a lot of risk in the market. Let's not get ridiculous in terms of the assumption that the market's going back to normal. So if there are any questions, if you want to know sort of where we're at right now, anything I want to talk about that I talked about that you want me to dive deeper on, know that I'm happy to do that. Just throw it in the chat. If you're watching this on YouTube after the fact, know that you can always throw your questions into the comment section. I'll do my best to get them, to answer them and just reply to you in the comment section, or I can always address it next week as well. So without further ado, I've got two ETFs that we're going to be doing a little deep dive into today. So the first ETF that I want to show you is a very interesting one. So I will talk just a little bit about all of the protests and the social unrest that we've been seeing in the US, but really all around the world. After the death of George Floyd, obviously so many of us were devastated watching that video, and it just shone a light on problems that we knew existed. And as far as I'm concerned, systemic racism is very much a thing, both in the US and in Canada. I've been doing a lot of work myself over the last couple of years, really trying to better understand the issues and asking myself how I can be a better ally. I've seen a lot of really cool resources, and certainly my impression, my feeling is that it's important for us to understand where we're spending our dollars. So I've been going out of my way to research and find Black-owned businesses here in Toronto that I can support. At the same time, looking at it from an investment lens, that's really what I do. So what I wanted to do was to highlight this specific ETF that exists. This is a fund called the NAACP Minority Empowerment ETF. So this is the only ETF that I was able to find that really has a specific focus on racial diversity and minority empowerment. So it's not perfect. I want to walk you through it. We're going to do a little bit of a deep dive to look at it, to see what's inside. The sort of TLDR, the too long didn't read, is that, it's an amazing step in the right direction. And I really am happy that this exists. I don't know if it's going to go far enough for a lot of people who do care about these issues. So let's get into it. So when it comes to this ETF, this is an ETF that tracks something called the Morningstar Minority Empowerment Index. So I'll show you the ETF, but to really understand why this ETF exists, sort of what's in there, we actually have to go to Morningstar to be able to get the information. So again, the life of an ETF always starts as an index, then a company comes along and turns it into an ETF. So in this case, we're looking at this, actually it's Morningstar, but I wanted the index. So I might have to go here. Here we go. That if I look at the indexes and then I can just find it very quickly. It's in their ESG. And then hopefully this search will come up quickly. And this is going to be by, sorry, what was it called here? The Minority Empowerment. So let me look up minority. I should be able to get all the different indexes here. You can see they do it in a bunch of different currencies. So I'm going to look at the US dollar version just because that's what the ETF is based off of. From there, what I want to do, I'm just going to go full screen just for a moment to be able to get this rule book because this is what I want to be able to show you. So if we look at this methodology, basically what they're doing is they're creating an index. It starts with US large and mid-cap companies. Morningstar has recently bought Sustainalytics. So this is going to use Sustainalytics data, so on ESG data, and they're going to exclude companies with controversy ratings of 4 and 5. It's on the scale of 1 to 5. So if it's a 4 or 5 related to the relevant social issues, they get out of it. From there, there's this minority empowerment score calculation. What they're doing is they're looking at these 10 different indicators. So board diversity, whether the company has a discrimination policy. They're looking at the scope of social supplier standards. So this is throughout the supply chain. Are there these measurements? Are we looking at that supply chain and measuring the standards that are being kept by those suppliers? They're looking at digital divide programs, so whether programs have the ability to, or whether companies are looking to bridge this digital divide by giving people access to the internet. Freedom of association policy, which is around the right to unionize. Diversity programs within the company, within the corporate structure. Supply chain monitoring, right, which is going to be sort of, in line with these standards. Not only do they have standards, but are they actively monitoring their supply chain? Community development programs. So this is going to be more on the philanthropy side, with community development. Whether the company has a health and safety management system, and then conflict minerals to be able to make sure that there's not, we're not exploiting people in that supply chain on the mineral side, which is a huge issue. From there, there's this security, the controversy rating, and these are the issues where they can't have a controversy. If they have major controversies around employee incidents, social supply chain incidents, society and community incidents, then they are cut from this index. From there, really what they do is they just kind of keep going through until they've got basically 200 stocks inside of it. So when we look at the ETF, there are going to be about 200 companies inside. We can look at the fund summary just to show you this one does trade in US dollars. So this is going to be a US dollar ETF. 175, so up to 200, but right now there's about 175. The fee on it is on the higher side. 0.76% is quite high for an ETF. And really the reason why it is because it doesn't have a huge amount of assets under management. There's only about $4.1 million here. So, if I do the math, if I do, let me just take this number, right, and multiply it by 0.0076, which is the fees that you're paying. This ETF only generates $31,000 in revenue per year, which is not a huge amount of money for all the legal, for all the everything. You're going to have salaries, right? Like this doesn't even pay one salary. So the ETF is quite small right now, which is one of the reasons why it's so expensive. What's interesting is that Impact Shares, the company that does it, they're actually registered as a nonprofit. I just want to see, where was it? Let me see here. I think it's home. Yeah, here it is. And what they're doing is they're structured as a nonprofit, but then they also partner with nonprofits, and all of the net profits go back directly to these partners. And in this case, the partner is going to be the NAACP. So really, if this is able to start making money in a meaningful way, then I wouldn't expect the fee to come down. I think it'll still stay fairly expensive. Instead, what they're going to do is just basically start making donations of any of that profit to the NAACP to be able to help them with the amazing work that they're doing. So when we look at what's inside, you can see all these different companies. Again, there are going to be about 200 different companies. Before I show you all the companies, let's take a quick look at it actually in Morningstar, so we can look and just see what the sort of breakdown is here. NACP, and then we'll be able to get inside the portfolio tab. We can get the geographic breakdown is going to be pretty much 100% US stock. This is a US, so really this would track against something like the S&P 500. We can look at the sector breakdown, right? And again, it's going to be quite similar to the category average. It is nicely diversified, a little heavier in tech, a little bit lower in energy, which I like, but it is going to have some mining in here, and it is going to have some pharma in here, and it is going to have all kinds of different companies in there. We can look at it from an ESG perspective. The ESG score is not that much lower than the average. This dotted line is kind of what they call the category average here, right? And then the score is going to be a little bit below average, but that's really not what this ETF is trying to do. They're not trying to have a low ESG score. It really is about companies on the diversity and minority empowerment side of things. What's cool to me is that it does have a fairly low carbon makeup. There's a bit of a caveat here, which I'll tell you about in a few minutes, but as it exists right now, it does have a carbon risk score that is much lower than the average, and fossil fuel involvement, which is much lower than the average. So I would say that's more by default rather than by design. I think it's almost like not that they got lucky, but it just so happens that it is fairly low carbon. From there, when we look at the companies inside, they do it alphabetically. So, we're going to want to keep an eye on the weightings just to see which ones are big. AT&T, Abbott. As we go through the list, there are going to be some companies in here that I think are going to be sort of head scratchers for a lot of people. Where is it? I believe the big issue that I had is Amazon. So when it comes to Amazon, they've had some huge problems when it comes to their workforce. That when we look at the methodology, I don't think I still have it up, but one of the things they looked at was the right to organize. And really, Amazon has been union bashing for a very long time. In fact, Amazon did a pretty bad thing where they fired one of their factory workers for organizing COVID, and let me just bring up the article here. But that basically they fired, it looks like these are two tech workers. A seventh Amazon worker has died of COVID-19. And then where was it? There was a black man who got fired. Here's sorry, I had the article, but I don't have it up on me right now. Amazon black worker fired, angry, because basically here it is. So what happened is there was a worker who was fired. Here it is. So let me tell you the story here. So Christian Smalls, basically he's a black warehouse employee who was fired by Amazon because he tried to organize a walkout arguing that the warehouse conditions were not clean enough and safe enough, that there weren't enough protections from COVID. So he tried to organize this walkout. He got fired, saying that he didn't quarantine himself or there was some kind of BS reason why they fired him. He's been outspoken. And then what happened is that in a meeting where Jeff Bezos was there, these notes got leaked to Vox, and a lawyer addressed the police killing of George Floyd and broader racial injustices in an email to his global legal staff on Wednesday. But what he wanted to do is this is sparking. Sorry, it's an older story, I guess. This is a story that is kind of breaking here. Anywho, a worker got fired. The lawyer called him some nasty things in a letter that he didn't think anyone was going to read, or certainly he didn't think was going to become public. It's created just an absolute sort of shitstorm where really people are pissed off at Amazon. I think everyone knows that Amazon doesn't treat their employees very well. And so it's just surprising for me to see Amazon inside this fund, straight up. What this tells me is that although I'm so glad they're measuring all these different things, I don't know if this fund is going to go far enough. If people are sort of activist investors trying to invest in minority empowerment, I think a lot of people are going to be like, WTF, why is Amazon inside? As well, the other kind of, little red flag that I did find is I was looking at their most recent filings, and I just want to see December 31st. It was this one. And when I looked through the holdings, this schedule of investments, here we go. You can see here, this is as of December 31st, 2019. So it's not at this moment, but this is what was inside of here at year's end. There were a huge number of energy companies. Many more energy companies were in here, including ExxonMobil, Kinder Morgan. There were a lot of nasty things that were in here. So to me, it's like, as well, I did see some tobacco with Philip Morris. Again, not in there right now, but was in there at the end of the year. As well, if I look at industrials, where was it? Here we go. Industrials. I did see a company like Honeywell, which produces weapons, and Lockheed Martin, which produces weapons. So those aren't in here right now, and it's really interesting. I wonder whether they've changed it. I looked at there because it's a US dollar fund. I looked at this. There are all these amazing resources from this Invest Your Values site. So this is an organization called As You Sow. And that, or I think asyousow.org. And they've got all these different tools. So we can look at it through the fossil fuel lens, NACP, right? And we can see what's in here. We can see that from a fossil fuel lens, again, now, looking at what's in there now, it gets 4 out of 5 badges. They only find one fossil fuel stock, which is Kinder Morgan, is the only thing that's still in there. So Exxon isn't in there right now, but, kind of cool. From there, I looked at it. I don't believe there are any weapons in here now, nor is there any tobacco in here now. But again, because it's not explicit in the methodology that these things are going to be avoided. Look, no guns, great. In terms of weapons, NACP. We can see that here there are 6 weapon stocks in here as of right now. Honeywell, which I pointed out, General Electric, Ball, Oshkosh, and AECOM. You can see here the little targets, things they have, major military contractors and nuclear weapons. So again, there are going to be some weapons in here, but I guess no guns. And I don't think there was any tobacco. That's right. So it looks like, yeah, this is funny. The only reason it gets a B is 0 tobacco companies, but they do look at tobacco promoting entertainment companies, which is kind of a cool thing. I hadn't seen that before. So, overall, if I'm comparing it to something like the S&P 500, this is definitely going to be way better. Like, it's going to be more sustainable. It is lower carbon. It actually does pretty darn well when I look at it through the MSCI tool. There are some laggard companies in here, but it's going to be a little bit better. Many more green revenues than brown revenues, and a fairly small weighted average carbon intensity. If we look at that 70 tons, and I can just compare it to SPY, which is the S&P 500, where we can see the carbon intensity 161, way more brown revenues, fewer green revenues, right? So you can see that it's definitely going to be better than the S&P 500. I just don't know if it's going to go far enough for people that really do want to invest in minority empowerment. The good news is that it has done better than the S&P 500. So I'll just chart it. I'll do it over the last 2 years. Let me see here. Oh, hold on. I might just have to do a little wider. Here we go. Let me just get to 2 years and then I'll bring it back for you. There we go. So this is the 2-year chart, and then now I can add comparison for NACP. Here we go. And let's see, I'll make this one black. And you can see that the NAACP Minority Empowerment ETF has outperformed the S&P 500 quite substantially by almost 7% over the last 2 years, which is great. But again, you know, this really speaks to the conflict that, you know, a company like Amazon, obviously I understand from an ethical perspective why somebody wouldn't want Amazon inside this. That said, Amazon stocks has been kind of ridiculous, right? And so if we look at it over the last 2 years, and you know, Amazon inclusion is one of the reasons why this fund has performed, right? And would investors be willing to get a lower return in order to avoid Amazon? You know, this is, I think, one of the fundamental questions when it comes to ethical investing. Everyone's going to draw the line at a different place. Personally, I'm so glad that this ETF exists. And I think it's amazing that we have these indicators. And I want to see more funds that use this lens explicitly in terms of their investment decision making. That said, you know, I do think that my guess is that they erred on the side of, you know, okay, we want it to track the S&P 500. We don't want to rock the boat too much, you know, and so some companies are going to squeak inside this portfolio that, you know, personally, I don't know how comfortable I would feel owning. So it is what it is. I'm happy to answer questions. But that's sort of my review of the NAACP Minority Empowerment ETF. I would love to hear your thoughts. I would love to hear any questions that you've got about it. You know, really, is this something that you would consider investing in? You know, again, this would replace the US equity portion in a portfolio. So there are some things I like about it, but there are also some things that I would say cause me to sort of shake my head a little bit, understanding that there are some trade-offs involved, and certainly it's not going to be perfect. Okay, cool. So that's the first ETF. Now what I want to do is provide a little bit of an update on an ETF that I know a lot of people likely watching this video likely own. And, you know, or certainly have looked at and been following. So this is the Horizons Global Sustainability Leaders Index ETF, ETHI. This is part of my model portfolio, what I call my Squeaky-Clean portfolio. So I've got it in here. This is, you know, in my estimation, one of the cleanest ETFs available in Canadian dollars. So you can see it's here. I'm actually going to have to redo this whole write-up because they went ahead and updated the methodology on me. So very, very interesting. This is a big update to the Horizons Global Sustainability Leaders Index ETF. To give you an idea of why, just the quick little background is that there's a company in Australia that does ETF called Beta Shares. And they've got the same ETF. So this ETF actually started in Australia before coming over by Horizons here in Canada. And in Australia, this thing is giant. I want the key facts. No thanks. This fund has so much money. Oh my goodness. Get out of here, weekly newsletter. It has over $677 million under management, which is absolutely massive. So this is obviously a very, very popular ETF in Australia. And for the longest time, it only had 100 companies inside of it, which was sort of one of my criticisms that, you know, it wasn't as diversified as I wanted it to be. And so because of its popularity in Australia, my understanding is that they were kind of struggling keeping it just to 100 shares. So that's why they've now updated the methodology. There are now 200 companies inside this ETF. So they've updated it. Let me walk you through the changes, and I'll be able to show you what's up with this. So we can see here that this PDF is now a little bit different. Down at the bottom, this is sort of the, I would say the spoiler that there are now 200 companies inside of it. It still starts with the large cap universe. It's still developed economies only. Their sustainability leader definition has changed a little bit. And what they've done is they've got this responsible investment committee who are kind of, I think, keeping an eye on things just to make sure that nothing squeaks through that really shouldn't be in there. So I think they are providing a little bit of oversight. But really what they've done is they've simplified the definition, saying that they're going to include companies with a carbon efficiency, so sort of a carbon footprint that puts it in the top third of companies within its sector. So this is going to remain very, very, very low carbon footprint. That is still the goal. And that we're really looking at the top third within each sector. From there, no changes here, still no fossil fuels, still no gambling, alcohol, junk food, etc. It still has to have at least one female member on the board. But the big, giant, major change for me is that it now has 200 companies rather than 100. So let's take a look at how it's changed a little bit. Notice that here it's only got 23 million here in Canada. Why is this so popular? Why is this so popular in Australia and not here in Canada? Won't know. Phil, yeah, congrats on the award. Thank you so much. Yeah, it's only taken me a decade to be able to win the award. Yeah, I'm not known for my quickness sometimes, but I get there. When we look at what's inside of this ETF, you can see it's still dominated by tech and by healthcare. So that hasn't changed. Although what I will say is that there are a few more sectors. We get a little bit more sector diversification, which I'm happy about, but it still is like overwhelmingly tech and healthcare. In terms of the geographic allocation, it used to be 75% US. Now it's down to about 70% US. So I'm still really, really comfortable with this. To me, this is fine. The standard benchmark is 55% US, but obviously it is heavier in the US than we would usually want to be in terms of a nice sort of geographically diversified portfolio. And it still doesn't have any emerging markets. So that's why we still do want to pair it with this iShares MSCI Global Impact ETF, which has less exposure to the US and does have exposure to emerging markets. So, that part of it hasn't changed. What's cool to me is that it does now have a little bit of Canadian exposure, that when it was only 100 companies, no Canadian companies made it through. But now there are a few Canadian companies. We'll be able to point those out. From there, I don't want the top 10 holdings. I want all of them. So when we look at the a full list of holdings, and they do it alphabetically, which drives me a little bit nuts. So let me just sort them here by largest to smallest, and I'll make it a little bit bigger for us so that now you can see the companies that are in here. So, one thing that I really did like is that part of the problem when there were only 100 companies, some of the companies at the top had a very, very, very heavy weighting. It was getting a little bit higher than I wanted to. So now they've, and I'm not sure whether they've capped it. I feel like they might have actually put a cap on the security holding as well. But it does mean that it's not going to be as dominated by the big companies, which again, I do like. Part of my issue was that it wasn't diversified enough, and this certainly, doubles the number of companies that are inside. When we look at it, there are going to be some companies that weren't in here before, but that now have snuck into this portfolio. So, I know Bristol Myers Squibb was in there before, but I feel like GlaxoSmithKline, I don't know if they were in there before. Here's Bell, BCE, so this would be the largest Canadian company that's in there. As we scroll through it, still, I don't think there are going to be any major red flags. it is still what I would consider like squeaky clean. However, something like Ford Motors does get in here. You know, I'd be curious to see, to make sure that they are in the top third. That surprises me that Ford would be in the top third of automakers. But, you know, I'll take it at face value. I assume that it is. You know, from there, as I go through it, again, Loblaws, another Canadian company. You know, I don't love them, but I don't really have any problems with them. Same thing with Rogers. You know, not my favorite company in the world, but I totally get it from an investment perspective and from a low carbon perspective. If there are any other companies in here that stick out to you or that you want me to look at or open up, by all means, let me know. I'm happy to dive into any of them, just to give you a little bit of a flavor. But really, this is my way of saying that I'm happy with the changes, that this is now a more diversified portfolio. Interjects sneaking in here at 0.02%. This is a Canadian renewable energy utility that I've got in my portfolio. And that, you know, so to me, this still is squeaky clean. I don't have any major issues with it. I don't think it fundamentally changes the index in any way, except that in my mind, it's just more diversified than it was before. Obviously, you might want to go through those companies and make sure that there might be something that kind of snuck through that wasn't in there before, that you didn't like. But overall, I would say that my take on it is that it is very similar to what it was before, but in my mind, actually even a little bit better. What's kind of cool about it is that, remember these fund ratings, right? So this was the SPY at about 162. When we look at ETHI, it's just incredibly remarkable how low the carbon footprint is. 17.7 tons, which to me is just incredible. And you can see here 0% brown revenues, 4% green revenues. So I'm really happy with this update. I think it's cool. I would say it's like an improvement from where it was before, but I would love to hear your thoughts. So, you know, ask me a question, throw it in the comments. If you're watching this after the fact, throw a comment in there. If you do have any questions about the changes to ETHI, then I'm absolutely happy to address those. All right, so those are the two ETFs. Those are the reviews that I wanted to go through. At this point, I'm happy to like open it up just to questions. If people just have questions, just throw them at me. Let me know what you think. Otherwise, I do have a few questions that people did pop up. So I'll just give it a moment for the chat just to see if there is anything that's top of mind. Otherwise, I'll just go to the questions that I got through email. All right, let's see here. So, okay. So, from Jerome, he pointed out a really cool thing for Quebec investors. So he's got some shares in something called CRCD, which is this Capital Regional Fund. And he's asking whether this could be considered an impact investment or not. So I'm going to translate it into English just because to me, I speak French, but it's going to be a little bit hard for me to do everything in French. What's really cool about it is that they do have this provincial tax credit, which means that if you invest $3,000 up to $3K, you get a 35% provincial tax credit. So you get like $1,000 back on your taxes in the form of a tax credit, which is kind of amazing. So this would be a huge incentive. I've seen this before in other countries, in other provinces. In Ontario, we had this thing called labor-sponsored funds for a while that had this provincial tax credit. But this is something that I would love to have, to be able to encourage more impact investments. From there, really, this is about local economic development. So let me see if I can open it up. Here we go. This is their little COVID thing. And then what they do is they provide loans. Let me just see. Oh, just have that. I don't know if I'll be able to get the full holding. Acquire shares. Find out more. Yeah, I don't know if I'm going to be able to dig too much into it, but I would absolutely consider this to be an impact investment. What this is going to do is this is going to provide capital for local economic development. These are going to be local businesses that are going to get loans, low interest loans or grants. So although there isn't going to be a specific social dimension to this or an environmental dimension to this, this is going to be a local economic development dimension of this, which in my mind is absolutely impact investing. So I'm going to be adding this sort of to my, I believe it's only available to Quebec residents, but I am going to be adding this to my list because it does look like this is available to everyday investors, and I'll have to dig in to see whether we can do it through an RSP or TFSA. I imagine it's something you're going to have to do directly through Desjardins, so we wouldn't be able to do it through an online brokerage system. But in my mind, this is a really cool local economic development investment fund. So thanks for bringing that to my attention. From there, I talked about CRBN last time, so we should be good to go there. I do have a question from Gael. So, you know, really the question is, what makes an ETF, you know, growing and becoming a good long-term investment? The companies in the ETF are economically growing and making more benefits in the real economy, or the fact that people, investors, are buying this specific ETF and making the shares more expensive. So she wants me to look at the example of T-Blue, which is a water ETF, or SDG, which is the Global Impact ETF. Why don't I use SDG, just because I brought it up before, the iShares Global Impact ETF, just to help you understand what impacts the share price of an ETF. So what we want to do is first, let's look up SDG. That's SDGA. I want to be very clear. It's not SDGA. It's SDG, which is the iShares MSCI Global Impact ETF. Please don't make that mistake. So, you know, really what she's saying is that this is an ETF that's going to go up and down and up and down. You can see the crash and then, you know, it's come back up. This one has done sort of remarkably well during the crash. And that when we look at all the different companies inside of it, you know, really the question is it the companies and the earnings and the profitability of the companies? Or is it investors in this ETF that are going to push the prices up or down? So this is an absolutely great question. And really what it comes down to is with ETFs, it's going to depend on the assets under management, how big the ETF is. Now, this ETF has about $110 million, which seems pretty big, but in the grand scheme of things, that is tiny. So when people are buying and selling this ETF, right, that's not going to have a huge impact on the price of the shares. It's not going to cause Umicore or Tesla to go up if somebody buys more or less shares of this ETF. It'll impact it a little bit, but it's not going to like really, you know, move the needle on it. That if this ETF had, let's say, 10 billion under management, that then whether a company is inside an ETF or not, then it starts to really matter. The way ETF performance is calculated is that at the end of every day, they calculate something called the NAV, the NAV, which is the net asset value. The net asset value is going to be the value of all the underlying holdings, right? All these different shares, the share price of Umicore and Tesla and Johnson Matthey times the weighting. It's going to add up the value of all those shares to give us this net asset value. Now that's only going to happen once a day. That within the day, during the day, the shares, the price of the ETF will be moving based on not only the net asset value and the shares, the value of the shares that are inside the ETF, but it can be impacted by the volume. That if a lot of people are buying it, that could push the price up. And if a lot of people are selling, that could push the price down. This is why oftentimes we talk about ETFs trading at a premium or discount. So you can see here, there's this little category, premium/discount, right? And we can see here through different ranges that on March 13th, this is when things were really bad. This was trading at a premium. That the fund traded above the reported net asset value, okay? I think this is a percentile. I think it's by about 3%. It might be $3. I might need to double check that. But my understanding is that this is a percentage. And that this means that because nobody was selling this during the crash, that the price of this ETF was actually a little bit higher than the net asset value. And that the greatest discount happened a few days later. This is again like right at the bottom, where actually probably somebody sold a bunch of these shares and pushed the price down below the net asset value by as much as almost 1%. So if we wanted to really understand how well does an ETF track the net asset value, this is what we would look at, this premium and discount. I'm guessing that these are going to be the largest numbers. Yeah, you can see during normal time, bit of a premium, only traded at a discount for a small little bit, that really the numbers are usually a lot smaller. They're kind of within a percentage or so, but it's really just during sort of super volatile times, because this is a newer or like a more sustainable ETF, that this premium or discount could get wider than it would normally be. So to answer your question, it's actually impacted by both. That on a day-to-day basis, at the end of the day, the share price is determined by the net asset value of all these different shares inside the ETF. But during the day, throughout the trading day, the share price is not going to be the NAV. It's going to be whatever the market, whatever people are willing to buy it at and sell it at, right? So that's why there will be some variation in there. But that's only during the day, during the trading hours. As soon as the markets close, they calculate the net asset value. That's what your ETF is effectively worth. And that if it was trading at a serious premium or at a serious discount, then we would assume that like the market is perfectly efficient and that investors are going to scoop it up if it's trading at a discount, or that investors would sell it if it's trading at a premium and then just like buy the underlying shares. I don't know how much that happens with these sustainable ETFs. I think a lot of people just buy and hold them and they're not really looking to kind of game it in that way. But this is why we would say that markets are supposed to be efficient, because if somebody was really smart and if they saw a premium or a discount, then there would be the opportunity to take advantage of that. So hopefully that answers your main question. That really the mechanism that it's going to be both the value of the shares inside and it's going to be the value, that net asset value. Now, in terms of the real economy, the problem is that there is often a huge disconnect between what's happening in the real economy and what a share price is actually worth. And Tesla is going to be a great example of this. Because if we look at Tesla, okay, and we look at the real economy, we look at their actual financials, right? This is going to be as of year end. All numbers are in thousands. So their total revenue was $24 billion. Hey, that's pretty good. $24 billion, not bad. But their expenses were also going to be quite high, such that their net income is, you can see the cost of their revenue, right? So they made 24 billion, but it cost them 20 billion, right? That means gross profit, but then they had R&D and they had to pay their salespeople and they have to do all this stuff, that their operating income was only 80 million, which is almost nothing. The cost of their debt, because they do have a lot of debt, is $685 million. And you can see that their actual net income was negative $862 million. So Tesla didn't make any money last year. When we look at their financials, you can see that Tesla, the revenue has been growing. They've been earning more, 7 billion, then 11, almost 12 billion, then 21.5 billion, then $24.5 billion. But they haven't actually made any money. So when we talk about the disconnect, right, it's that we're saying that Tesla isn't actually profitable. And yet, when we look at their share price, let me look at the chart. This is something that has just absolutely gone to the moon. Let me get rid of these guys and let me just scroll down a little bit. That this is the last 6 months. Let's look at it over the last 5 years. You can see Tesla, $200 a share, all the way up to $350 a share. Whoa, it was trading up there for a while, and then all the way back down to $185 a share. And then remember, we had almost what I considered a bit of a bubble where it went all the way up to 900. And again, this was people trading. This was like a lot of activity in February, right? Where a lot of people were, riding this Tesla wave. And then, oh my goodness, it came all the way back down to $427. But now just in the rebound, and then just even in the last couple weeks, Tesla has just shot right back up, that it was momentarily, I believe, over $1,000 per share. Yeah, $1,025, which like this is the disconnect. That Tesla isn't making any money right now, and yet the stock market values them as if they are wildly, wildly profitable. So, it's a really tricky thing. Part of it is the psychology. A lot of people believe in Tesla. They think it's going to grow, right? But this is where we would say that there's this disconnect between the real economy and the stock market. Because we have the real economy, we have the numbers, we have things as they exist today. But the stock market is really this like projection over the next 20 years. How much do we think is going to be generated over the last 20 years or over the next 20 years? And then pricing that today. So that's where it is a little bit, this is where there's sort of the crystal ball and, and why are people buying it? And this would be a case where a lot of people were buying shares of Tesla, pushing it higher, right? Is it overvalued? Probably based on today's earnings and today's prices, right? Like it's kind of like when you watch Dragon's Den and the company is like, we're worth, so Tesla like walks into the Dragon's Den and says, hello dragons, my company is right now worth, $180 billion. And the dragons are like, well, okay, how much money did you make last year? Well, we had, what was it? 84 or $24.5 billion in sales. Okay. What was your profit? We lost $862 million. Okay, so how are you worth 180 billion if you only made 25 billion and it wasn't even profitable? So the only thing is to say that people believe in Tesla, that they think it's going to keep growing and they think it's going to grow into this valuation. And that, this is obviously an extreme example where it's just such a high valuation. There are other examples like this of companies that we think are very, very, very overvalued. But, if investors are willing to pay at the end of the day, a commodity or a good or a service or a stock is really only worth as much as people are willing to pay for it. And right now, people are willing to pay $972 per share, even though the company isn't making any money. And it's really based on faith and trust that Tesla is going to keep growing. And that, it will grow into this $180 billion valuation. Hopefully that makes sense. I did see a question from Lauren. Are there any Squeaky-Clean US listed US equity ETFs? I do have one for you. I actually got an email. I got a request from I think it's the executive director of this ETF. He wants to come on the show. So I think I'm going to invite him on probably in a little while. And that we're going to get him to talk about something called the Change Finance US Large Cap Fossil Fuel Free ETF. This is, I would say, my sort of squeaky clean one. You can see it excludes oil, gas, coal, tobacco, all fossil fuels, utilities that burn fossil fuels, nuclear power, GMOs, military weapons, pesticides, a whole bunch of different, controversies, right? And also companies that fail to meet minimum standards related to social environmental impacts, right? So all kinds of wonderful things there. We can see here it started in 2017. It's got about 17 million under management, so it's still small. It's not tiny, but I would like to see it continue to grow. I want it to be better at an expense ratio of 0.49%. When we look at what's actually inside of it, I think the holdings are down here. Download full holdings. Here we go. Open them up in Excel. Get them a little bit bigger here. As we go through, and again, now they have an interesting thing where they tend to be a little bit more equal weighted. So what they do is they make all the weightings the same. Obviously, if something goes up, then it becomes worth more within the fund. But you're not going to see the big companies at the top here. So you can see here as we scroll through it, you know, Chipotle's in here, Apple is in here, Microsoft, Autodesk, right? Ecolab, I like them. Cisco, I wrote a piece on them. You know, as we go through it, it really should be quite what I would say squeaky clean. There is going to be some big pharma, Pfizer and Bristol Myers Squibb. It's tough to get away from pharma. I've really noticed that. You know, but overall, there is some gambling in here. That's interesting. This is usually something that's screened out, but they do have MGM Resorts in there. That's interesting to me. Let's just look it up real quick on some of our search tools. So I can just show you here, MSCI, or sorry, CHGX. Oops, there it is. Here we go. So it gets an overall A rating. This is interesting. It does, you know, I'd be really curious to see what laggard, what triple C rated company is in here. No brown revenues, lots of green revenues, 45.9 ton CO2 intensity. Good job. Very, very low carbon footprint there. This is interesting. There is one red flag here. So to me, this would be, you know, an OECD guidelines, very severe controversy. So I don't know if this is a new thing. Again, I can't see which company that is. But, you know, interesting to me that this picked up a screen that theirs didn't. So I'd be curious to see sort of how they're doing that. And then from there, we can look at it, you know, in terms of fossil fuel free funds. We can look it up, and I'm very confident that it's going to be clean. Yeah, I can see here it gets an A grade, so that makes me happy. 5 out of 5 badges. In terms of, you know, the other things, I know there's no tobacco. Let's look at weapons. I think it was here. No, that was tobacco. But if we look at weapons, there shouldn't be anything in there that it really should be squeaky clean as far as I can tell. Yeah. A grade, 5 out of 5. That's great. So from there, let me just show you the chart. Now, again, this is a bit of a tricky one. I would probably compare it to the S&P 500 as a US equity, although again, it is like equal weighted, so it does have a bit of a different profile. But let's see how it's done compared to the S&P 500. Let's do it over the last 5 years. It's not that old. CHGX. Here we go. Let's make it purple because I like purple. And you can see here that it's tracked very, very closely. Looks like, let me make it 2 years. I think we'll see more of the track record here. Yeah, great. Actually, you know, it looks like it's outperformed the S&P 500 over the last 2 years. Good job, Change Finance. That, you know, really it did sort of get a bit of a lead. And that, you know, it's certainly in the crash, it's bounced back up quite a bit more. And it's interesting, we'll see. And again, you know, just with today, with this price, it might be that this price here, you know, was sort of the last price that it traded at. It might not actually be that net asset value. So I find sometimes with the sustainability ones, the most recent date, I can't sort of really trust that. But I can trust that, you know, this one was up 14% at the end of day yesterday. Whereas, oh, no, that was 14%. This would be up over 21%. So, you know, it has outperformed the S&P 500 while in my mind still being quite squeaky clean. So Lauren, if you are looking for this US listed US equity ETF, in my mind, the cleanest one is going to be the CHGX Change Finance. And what do you guys think? Do you think I should have the executive director on the show? What kind of questions would you ask someone? If you could ask someone, you know, about how they created this ETF and kind of what goes into it. I'm really worried. I wouldn't want it to be like a sales pitch or something like that. You know, I would want you to get value in terms of the education piece. So please, please, please send me questions or put them in the comments. You know, if you're watching this after the fact, you know, what are questions that you would have for the CEO of Change Finance? I believe his name is Andrew Rodriguez. So let me just see if I can find him, who we are, our team, read more. Here he is. So Andrew, you know, CEO and Chief Investment Officer. So what do you think? Should I have him on the show? I think it'd be cool, but I would want to get some good questions so that we could have a fruitful conversation. All right, good work tonight. That was really good. Thank you so much. I'm not seeing any other questions from the chat. So let me just make sure it hasn't frozen. Sometimes the chat has frozen on me. So let me just double check that you guys are good to go. But no, I don't think there are any other questions here. So I feel pretty good. about tonight's show. Hopefully you've learned something as well. Thank you so much for joining me. If you've watched the whole show on YouTube, don't forget to like and subscribe. Really, I'm trying to get the YouTube algorithm working for me. And the biggest thing is subscribers and comments and likes. That engagement on the video just means that this is going to show up in the search feed and show up in the recommendations for other people. So if you do like this video and you like what I'm doing, please have that engagement on YouTube. It'll really help the robots run things in my favor. Otherwise, everybody have a wonderful night. Have a great week. Stay safe, and we'll talk to you next week. All the best.